Welcome back. I will now talk about some basic aspects of bonds. Unfortunately, in this part of finance, there are so many different terms that are used. The jargon is really quite important, and it makes it hard in the beginning to understand what people are talking about. So in the next few slides we have a nice summary of the main features of bonds and bondholders and different ways to classify bonds. So in particular we talk about some common terms we use. We then move into risk aspects, in particular default risk and ratings. We talk about fair prices and certain conventions in terms of pricing. Now, first of all, bonds are debt securities. It's quite different from what you might have seen when analyzing equity, because bondholders are not owners of the firm. They are in a position of getting a contractual payment. Now, this contractual payment is the interest payment, and of course the promise to be repaid throughout the life of a bond or at the end of the bond. So in terms of risk return profile, this is very different from equity holders who have a so-called residual claim, which means they get whatever is left from the cash flows after paying interest and repaying debt. In terms of risk factors for a bondholder, the main concern is a default risk. So if the company cannot pay the interest or the principal, the company defaults. The only benefit you have as a bondholder compared to an equity holder is that you are first in line. Now, there are of course differences depending on the type of bond. So there might be a difference in terms of so-called seniority of bondholders. In terms of what's the usual setup, the most common bond has a fixed coupon payment. Now, the coupon payment is your coupon rate times the par value of the bond. That's your coupon payment, or you can call this the interest payment. In most cases, these payments are done semi-annually. So you have two payments a year. And it's also common to have a fixed period to maturity. So quite commonly might be 5 or 10 years or maybe a little bit longer. And at the end of maturity, you return the principal or the so-called par value or nominal amount. So basically the money a company owes is paid back to the bondholder. So these are the standard bonds. They are also called the straight bonds or the plain vanilla or bullet bonds. And in most of our examples we focus on this common type of bond. But of course there are many alternatives, and also we will come across a few of them in this course. Now, there are many conventions in terms of naming conventions, and also conventions in terms of how prices are calculated. Now, first of all, the par value or face value or redemption value, principal, maturity value, all of these terms mean the same thing. They refer to the amount that is repaid, usually at the end of the period at maturity, sometimes throughout the period. Now, that's the amount you need to calculate coupon payments. Now, very often in our examples we either call this the principal or the par value. So I try to stick to these conventions, but you see in various textbooks different terms used. Then we have the term to maturity or term, which simply outlines the number of years until the par value is paid. And then, of course, there are different types of short, intermediate, or long-term bonds, and we will talk about this in a bit more detail when we explore the short-term money market. Then we have the coupon rate or nominal rate. So this is stated as an interest rate of a bond. Yeah. So, for instance, if your coupon rate is 5 and your par value is 100, it means you get a payment of 5 units depending on the currency. However, this is usually paid twice a year. So you would get half of that in the first half of the year and half of that late in the second half of the year. Then there are some bonds that do not have any coupon payments throughout the life of the bond, only a repayment at the end of the life of a bond. So at maturity, these bonds would pay a principal, and the interest is implied by the price of the bond when the bond is issued. These are so-called zero coupon bonds. So, for instance, a zero coupon bond might sell at, say, £80 for a par value of maybe £100 in 1 year's time. That means that you spend 80 now to buy this bond, you get 100 at the end of it, so after 1 year. And of course you can calculate from these values a return. And this return would be a yield to maturity for this zero coupon bond. Now, zero coupon bonds are very useful in terms of pricing of cash flows. We will come back to them later in the course. Now, there are many features of bonds. So one important aspect is amortization feature. So some bonds, and usually the majority of them, they do not have any repayments throughout the life of the bond. They only repay at maturity. So this is I would say, the vast majority of bonds in terms of repayment structure. Some securities are different, where you have repayments throughout the life of the bond or the security. So an example is, of course, the mortgage market. So if you go into mortgages and you want to buy securities based on mortgages, here repayments happen throughout the life of the security. Now this has implications, of course, for pricing. We have to then think about certain assumptions we have to make, and we will come to this a bit later in the course. Some bonds have so-called embedded options. So some might have some call features included, sometimes put features, some might be convertible, exchangeable, and so on. Now all these different features can be quite complicated, and also they affect, of course, the pricing of the bond, and then of course one has to think very carefully what's a good method of pricing. And lots of energy is then spent on optimizing your asset pricing model to capture certain aspects of a particular bond. Then, of course, bonds are differentiated according to the respective issuer. So, of course, we have sovereign debt. So these are issued by governments like UK gilts. We have a very significant corporate bond market and so on. And of course also there are differences depending on the type of company you consider. So in particular there's a big difference between financial service providers that issue bonds and non-banks issuing bonds. There's quite a significant difference in terms of risk profile. Now again, the currency matters as well, and there could be a currency risk associated to holding bonds, and this exposure again has implications for valuation. And then of course there are different types of risk, and these risks also depend on various bond features. And so in particular, if you have some embedded options to consider, it makes this an awful lot more complex to analyze. Now, you definitely have seen before bond ratings. So bond ratings are used to classify the risk of bonds. The focus is on default risk, which is the main risk you bear as a bondholder. There are different rating agencies, so I just put here the Moody's ratings and Standard & Poor's, so these are the two largest ones. There are many others as well. There's Fitch and other rating agencies. These rating agencies explore a company or maybe also a sovereign entity, and they assess the likelihood of default and then assign a grade to it. Now, for the vast majority of corporate bonds, this is available, in particular for larger entities. You will find it more difficult if you go into emerging markets and if you look at smaller issues. Then sometimes you might not have any bond rating. Now, there's a lot to say about bond ratings. Honestly, in terms of reliability, I would be always very skeptical with it. There's a tendency that rating agencies herd, so that means that if one rating agency starts downgrading a bond, another one might follow. So there is also a tendency that they seem to lag behind the market. So what I also do quite a lot is I just look at market data, and in particular look at the actual prices of bonds comparing different ratings. So here you see as an example, now this is for the US, I have done this study a few years back. Just as an example, we have AAA rated Moody's and BAA Moody's yields over time, and you see there is quite a bit of a gap between these different types. You would of course expect that if you have a weaker rating, you have a higher yield because you need to compensate bondholders for the increased risk of default. But of course these yields, the yield differences, which is the spread, is changing quite a bit over time. And that is something to note. And of course the other issue, which is not easily captured, is that other aspects of risk, in particular liquidity risk, and we talk about this in a minute, also affect the spread. It's not only default risk. And of course officially the ratings, they focus on default risk, which is only one aspect of risk. And of course then it depends on a whole list of other features of bonds that might matter in this relationship. Now here is the spreads for these two time series, and you see you have a few spikes here and there, which of course do matter in this particular setting. Now this of course is quite relevant to analyze before you consider investing in bonds, but again have in mind that these spreads reflect not only one risk aspect but a whole set of factors, which I outline on this slide. Now, as I said before, the main aspect is default risk, so that's the bulk of the risk, but it's not the only factor. The other thing which we have to consider is liquidity risk, which is very relevant, in particular if you go into corporate bonds. In the case of sovereign bonds, liquidity is usually quite high, so liquidity risk is less of a concern. Now, very briefly, what is liquidity risk? Now, liquidity risk means that it might not be possible to buy or sell a security at a given price. Yes, if you look at the market and you see a price of say 100, it might not be possible to buy or sell at this price the quantity you want, because you always need a counterparty. You need someone who is willing to buy or sell at this price level. In particular, if your own trade has a strong impact on the market price, then this would indicate a significant liquidity risk. Now, liquidity matters an awful lot, in particular in the case of corporate bonds, because very often they are not traded frequently, so it becomes quite difficult to sell them off before maturity. And in particular, if you are a large player like a pension fund, you have to be very mindful of that, and that you might struggle to sell off assets if you need liquidity. Yeah, so that depends very much, of course, on your so-called liability structure. So when do you need the money? When do you need the cash flows? As long as you can plan for it, the liquidity risk is less of a concern. And then, of course, we have a whole list of other risk factors, in particular if you have, for instance, embedded options, then volatility matters, because volatility is one important driver of option prices. Yeah. Then exchange rate risk matters if you have securities in different currencies. And of course, you can then explore hedging strategies to try to balance that risk or to mitigate the exposure. Inflation risk also matters, yeah, so it depends, of course, again on the type of bond. Some bonds are what you call index linked, in particular some sovereign bonds are, so they protect against inflation. But then it depends very much on the details, so what type of inflation measure is used, for instance, and again there are major differences. In terms of calculating returns, and you will see this later, there is one important aspect about what you call reinvestment risk and call risk. So some bonds are callable, so the entity that issues the bond can call them back for a certain price, yeah, so which might be in their favor depending on how the market develops. So there is a risk then that you might not be able to find a similar suitable investment for your money. The other thing is, of course, if you get your coupon payments, what do you do with it? Yeah, so usually in our calculations we implicitly assume that you're able to reinvest these payments into a security that gives you the same return, which might not be the case depending on liquidity constraints, for instance. So these are all the different factors that matter, and of course it depends an awful lot on exactly how the bond is structured. The same applies, of course, to interest rate risk. So in the vast majority of cases you have fixed interest rates, but sometimes you have so-called floaters, where the interest rate might change under certain conditions, and then of course you have a significant impact which could be positive or negative on your coupon payments. Now, in terms of option pricing and pricing of debt securities, we have to consider all these different aspects. We already derived this equation here, which gives you a fixed coupon payment for a certain period of time and the principal or the par value at the end, denoted M. Now this is a standard pricing equation which works for certain types. So in this particular case you would have the implicit assumption that you only have annual payments, which of course is not usually true. So usually then you have to modify this by a factor M in here to account for the fact that interest payments are more frequent, usually semi-annual. And again, we have discussed this already in other recordings, how to make that particular adjustment. And then, of course, the big question is, what's a good discount rate? And this is, of course, then a core issue around various pricing models. And there we will explore this further when we talk about asset pricing. And in some other recordings, we actually derive these discount rates as so-called internal rate of return, where we find a discount rate so that the current market price implies an internal rate of return, looking at all the future cash flows. So we basically balance future cash flows with current prices using using the internal rate of return. Now, in terms of behavior of the asset value, bonds are very, very special compared to other asset classes, and this has big implications for pricing. So one important feature is that if the company does not default, so under the condition there is no default, that at the end of the life of a bond, so at maturity, well, the bond value has to be equal to the money you get, which is your par value or your principal. So at the end of maturity, so once you hit that point, the value of a bond, assuming there hasn't been any default, is equal to the principal. And of course, throughout the life of a bond, the bond price will change, reflecting all the different risk factors we spoke about. So if you are above par value, you have a premium, which of course then has implications for your yield, but it might be justified because maybe there are certain features of a bond that are beneficial, maybe a very high liquidity, for instance, or you might be sold at a discount, which of course then has again implications for yields in this particular case. But at the end you see that it concentrates on one point, and this has implications of course if you look at your variance of your bond price. At one point it has to collapse to zero basically, because at one point things are certain at the point of maturity. Good, so that's now a figure on clean and dirty prices. It's just building up. It might take a few seconds. Now, it is a convention that the prices we quote are clean prices. Now, what does that mean? So if I hear, for instance, the price of a bond is 102, it doesn't mean that I can actually buy the bond for 102. For maybe a par value of 100. So I might not be able to do this because there might be some accrued interest. Now the accrued interest matters because this is interest which hasn't been paid yet, but it's about to be paid at a certain date. And this needs to be accounted for in what you call the dirty price. So the dirty price is your clean price. So this is in fact the one we tend to quote, and the accrued interest. Now the difference of course depends very much on timing of payments, and I do it I think best using an example. So what we do is we look at how many days are there between the time of buying, selling the bond and the time where payments are made. Now actually it's much easier to go straight into an example. I think this is much more intuitive. Now in this example we have someone, Jim, buying some gilts, so UK government bonds, and this person invests 25,000 nominal, so in nominal value. And there is a coupon of 7%, and it's done on the 27th of August, and the payment dates are the 7th of June and the 7th of December each year. The nominal here is 100, so this would be the nominal, and now the issue is how can we determine these accrued interest payments, and what's the clean price and what's the dirty price. So the clean price you see is denoted at 102.4375. Now what we need to do is we have to look at the difference between our interest payment period. So these are the dates for the coupon each year, and the date where the trade occurs. So in this case there is an 81-day difference in terms of the last payment and the current date. Now this can be easily calculated in Excel. I'm always very bad when it comes to calculating days from dates. You can just throw this in Excel and Excel is doing this for you. I just have done this right here. I just put in the 2 dates and it gives me 81 days. Yeah, and of course this is exactly how I would do this, otherwise I go insane counting the days. So we have 81 days in between the last payment on the 7th of June and the 27th of August. Now in this period interest has accrued and this has to be calculated. And it's done by simply taking the coupon payment, which in our case is 7. Yeah, we have a nominal here of 100, so I can take the 7% and divide this by 365. Of course, you note I have 2 payments per year, so the alternative in terms of calculation is to divide not by 365 here, but divide by half of it, and then adjust the coupon rate to 3.5. But of course, mathematically, it's entirely the same. So this would be the accrued payment you would make because of the accrued interest. So the dirty price is your clean price plus the accrued interest. So the clean price would be the 102. Again, this is for 100 nominal. Yeah, so I use 100 nominal here also for my calculation. And I get this combined dirty price. And then I can of course calculate this, again noting that the 25,000 is the nominal amount, so this is the actual payment I have to make, which is a combination of the clean price plus the accrued interest. So that's just a nice illustration of what is behind that convention. Good, I see you in the next one.